Hello, this is Steve Malone, ComSaveX. Hope you're doing well today and you're getting some good trades. Over the last number of weeks, we've seen a number of currency pairs fluctuate or cycle within a range, and we've seen increased volatility around certain news announcements. And I'm not talking about the ones that everyone focuses on, like non-farm payroll, but even today, the ISM manufacturing number that came out was a bit of a surprise to the marketplace. And so today what I want to do is to share with you an advanced trading technique designed to trade ahead of the news. You need to be disciplined in how you trade this with proper money management. I suggest low leverage, and also go through the certain steps to set up for the trade. There's certain things that I look for when I trade it. Now today in my live active trade room, I did catch the euro dollar making a move down. So grab a pen and paper and take a few notes as we go through this. Now the first thing I do is I want to take a look from a bird's eye view as to previous highs and lows in the marketplace. And in doing so, I want to get a buffer zone above current price and a buffer zone under current price. Because sometimes what I've found is when a news announcement comes out, it will gyrate in different directions until it finally decides which way it wants to go. So I give it a bit of a buffer zone to do that in, and then I enter in the trade. So if we take a look at the euro dollar 5-minute chart, today we had the report of the US ISM manufacturing number come out at 10 a.m. Eastern. That's represented by this dotted line right here. Now the report came out much favorable than expected. Last month it was 53.4 with the expectations actually for it to drop down to 53, but when it came out 54.8, well, that surprised the marketplace. And when it did, we had the historical move of the euro dollar making a move down. And what I was looking for as this made this move, notice how the market actually moved up to a high point before the news, cleared out some stops, it looks like to me, before the market came down. And then it went into what I call a buffer zone. We'll talk about that in a moment. And then continued making a push on down. So I want to talk about the buffer zones, and I also want to talk about the targets for this. Okay? When you're setting up a trade that is ahead of the news, it's important to look at what has the market done to a certain point. What have been the lows it's achieved and what have been the highs it's achieved. Well, I had to go back to February 2012 to find this, but we had repeated highs right around 32.87. And there was talk of option barrier sitting at 133, the psychological barrier. So my thinking is there's a possibility the market may break this 32.87 high that's been repeated a number of times since February of 2012. It may try to reach up here to 133 even, and it might bounce off the 133 option barriers, but it might push through. So what I'm going to do is give it a little bit of area to bounce within to see if it's going to actually make its move up. At the same time, I noticed that back here I had this low point, average low, and I had this average high. We basically had a range back here, so I got to thinking, well, it's possible that this could come down, shake out all the short sellers in the marketplace, and then push right back up. So I was looking for a break below this level, and as a matter of fact, in my live active trade room today, I did enter the market short on the euro dollar at about 132.40, letting it clear this buffer, and then it moved on down. Now, is it possible I could have got in up here? Yes, but that really didn't leave me a whole lot of room for the market to gyrate. And many of us know, having traded the Forex market, that in the first minute or two of a news announcement, there's the possibility the market will make wild swings up and down. It'll gyrate before picking a direction. Therefore, I use buffer zones. So in this case today, the market came down, it went through my little buffer area, and then broke underneath the buffer area. It looked like it was holding, and then I entered the market at 32.40 and let it come on down. Now, looking at the Traders Dynamic Index, I noticed that we had lower peaks here, indicating sentiment was falling. So in this case, price, based upon what happened with the report, price followed sentiment. Again, when price action and market sentiment are aligned, you trade in that direction. So we saw both of these making a move down. Now, as far as the target goes, I simply use a technique. I use it all the time in my active trade room. It's taking the Fibonacci retracement tool, running it from, I'm going to go this swing low up to the swing high up here, and look what the market did. The market came down and sat pretty much right on the 127.2, went down to the 140, actually went down to 141.4, bounced back up to the 127.2. Then moved down to the 1618, and look, finally it pinned right down to the 132.03 and started bouncing back up. And I mentioned to folks in my active trade room today, as we were trading this, I said, look for this to potentially break the 132 handle. If it doesn't break the 132 handle, it's coming back. I set myself a pretty tight stop, and it came out at about 32.10 in my position. Now, along the way, I did scale out of the position. That's just my trading style. But still, we caught this move down in the active trade room. Now the question is, well, Dean, what if the trade had gone the other direction? Let's say the ISM manufacturing number came out as expected. Then I wouldn't actually see this amount of movement. But if it came out worse than expected, again, they were expecting a number about 53. Let's say it came out 51.5. It was much worse than expected. Then I would look for this in the opposite direction. I would have looked for the market to make a push into this area right here, this buffer area, bounce around and then break the buffer. And then I would simply have ran my Fibonacci retracement tool in the opposite direction, looking for a move from the 127.2, the 141.4, 1618 up to the 200. And you can see in this case that the 127.2 is inside the buffer, so is the 141.4. So a break of this, we've seen 3306 or 3307 there. Then potentially 3321, then the 233, 133.34, and eventually maybe the 2618. Now there was a number of offers stacked up in the marketplace between 33.34 to 33.50, and I might have come out of the position somewhere in this area. But that is how I trade ahead of the news, is going through this process of identifying a buffer above and a buffer below the price, because I have seen where the market will make a bounce up and a bounce down, a bounce up, a bounce down, and then pick a direction. Well, I know that some of you may be asking the question, well, Dean, what if it goes beyond that buffer, you enter the trade, then it reverses on you? Well, it happens, and it has happened to me. That's part of trading ahead of the news. So in that case, you can potentially have a buy stop above 133 and a sell stop below this 132.44. Now let's take a look at what happened to the Aussie dollar using the same trading technique. Okay, taking a look at the Aussie dollar, last night we had the Reserve Bank of Australia's interest rate announcement at 12:30 Eastern, represented by this dotted line. Now, economists were expecting the Reserve Bank of Australia to come out with only a 25 basis point. A handful, were looking for maybe a 50 basis point cut. Well, that surprised the market when they went that far with a 50 basis point cut. So they went from 4.25% down to 3.75. And we see here a strong move to the downside, jumped literally through the buffer in this case. But look what the market did. Bounced right back up and then started coming back down. At this point, you monitor what the market's doing. And in this case too, one of the things I want to point out is if I go short here and it shoots back up here, where's my stop? Well, your stop can be back up here, either above the buffer, inside the buffer, or ahead of the buffer. It's depending on how tight you want it. Then the market settled back down a little bit as it jumped back up, and then it dropped. At this point, you simply use your targets. Again, from swing low to swing high, you can see the market literally just took off beyond that. So what I would do is simply take this and go to previous swing highs. You can see here the market went down to the 233, back to the 200, down to the 2618, dropped a little bit below. You could move it all the way up to the highest point up there. And you can see pretty much the same scenario here, where the market had moved down to the 200, 233, pinned right to the 233 in that case. Anyway, this is a technique for identifying the targets. Again, place your stops in appropriate areas, and oftentimes that's beyond the previous buffer, just to give you a little bit of room, or you can tighten it down when you trade. But again, this is disciplined trading. Do your setups, use low leverage in these situations. But this is a technique of trading ahead of the news. Well, folks, this is Dean Malone with Compass FX. I hope some of this information will help you in the forthcoming announcements that we have this week. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.